In this video, we are going to be looking at the possibility of a second market crash, something which I didn't previously think was going to happen, but with the increase in cases of COVID, particularly in the US, but also in pockets of the UK and wider Europe, it's beginning to look like a much more serious possibility. We're also going to be looking at how I plan to protect my existing portfolio, alongside what buying opportunities I am looking out for to potentially try and take advantage of another market drop. So let's get into it. So hello and welcome to the channel. If this is your first time here, my name is Henry, and this channel is all about sharing my views and ideas on the stock market, which includes trends, specific stock picks, as well as also sharing my journey of my own portfolio with you. It would be great to have you along for the ride and to share ideas, so please hit that subscribe button to show your support. It would be very much appreciated. Right, so what is happening? Well, clearly we had a massive sell-off in March due to the virus, causing lockdown around the world, as can be seen here in the charts of the iShares S&P 500 tracker. But since then, we have had a very fast V-shaped recovery, and hope of a swift economic recovery spread throughout the markets. And life was great. A lot of people managed to buy a lot of great stocks at really good prices, and we're seeing very quick profits on those stocks as they bounce back, me included. However, as lockdown restrictions have started to be lifted, cases have started to increase again, and I think it would be fair to say have spiked in certain areas or countries. The US, for example, seems to have booming cases, something Trump seems in complete denial about, unsurprisingly, given the upcoming election. But we don't really want to get into that. So, what does it mean? Well, increased cases creates increased uncertainty and extended periods of lockdown worldwide, affecting economic activity and growth and employment. Long story short, the stock market is likely to take another big hit, and we may well have seen the early stages of that in a sell-off towards the end of last week, as you can see here. Facebook, for example, if I flick to this tab, dropped over 8% in a single day, which in itself may provide a great buying opportunity from just one day's price movements. So, as long-term investors, what do we need to do? Well, three things. Number one, analyse your portfolio. And what I mean when I say this is make sure the stocks you hold, or at least the majority of the stocks you hold, are of good quality. At a time like this, when a number of large businesses are struggling financially, there is a serious risk of companies going bankrupt. Now, I am all for holding some risk in your portfolio, a calculated gamble. But holding too many of these types of stocks, especially at a time like this, is a risky game and could end up costing you a lot of money. So let's have a look through my portfolio now and assess what I think may be too risky. So if I pull this up here, we can go through from the top. Square I'm happy with. Dart Group is an airline stock. It's the parent company of Jet2, and it's probably one of the most risky holdings in my portfolio. We're currently at 40%, and I would not be surprised if that drops significantly next week. That being said, it is a company that I believe in. It has got a very good balance sheet in terms of airline stocks, as you may have seen in my previous videos. So that is one I'm definitely going to keep keeping hold of, and is a risk rewards play I'm very happy with. Next we move down Apple, Facebook, Amazon, obviously three of the FANG stocks. Stocks that I would consider very safe, and therefore are stocks that I will be keeping hold of. Tesla, again, I'm happy with. Barclays, I'm happy with. Big Box REIT, I'm happy with. Same as Segro, two very safe industrial focused REITs there. Microsoft, very safe. Tencent, I'm happy with. iShares S&P 500 tracker, I'm happy with. Illumina, slightly more on the risky side, but again, I'm happy with. Visa, very safe. Alphabet, Google, very safe. Emerging Markets ETF, very safe. Bank of Montreal, I'm happy with. Unilever, very defensive stock. Comcast, quite a defensive stock. FTSE 100, I'm happy with. Very well diversified. Another bank, Bank of America, which I bought at a very low price, so again, I'm happy with that. Thread Infrastructure, happy. Alibaba, I'm happy. Omega Healthcare Investors is probably, along with Dart Group, one of the riskiest plays in my portfolio. So this is a REIT. It is a REIT that focuses on healthcare, but they do have a very high payout ratio at the moment, and that is something that concerns me. So if they start to struggle with tenants not paying rent, we could see that dividend be cut quite substantially, and therefore the share price may take a hit as well. I think at the moment it's one I'll hang on to, but it is one I'll be watching very closely. McDonald's I'm happy with. InMode again is probably more on the risky side, but I've done a lot of work on the company financials and they are one I'm willing to take a risk on. Happy with Johnson & Johnson, happy with JP Morgan, happy with Coca-Cola. So out of my whole portfolio, there's probably 3 stocks I would consider risky or to carry a certain degree of risk, and that is InMode, Omega Healthcare Investors, and Dark Group. So in terms of my overall portfolio, they will not make up more than probably 7 or 8%. So my exposure to risk over the long term, I am happy with. I would encourage all of you to undertake a similar exercise on your portfolios and just make sure you aren't overly exposed to too much risk going into what could potentially be a second wave. So moving on to point number 2, we need to prepare ourselves mentally. There is the possibility of another big market sell-off as investors once again get spooked by the increasing numbers of cases and the effects that may have on the economy. A lot of retail investors will end up selling their shares out of fear the values will drop to zero and they will lose everything. In reality, if you have undertaken step 1 properly and have properly considered the risk of the stocks in your portfolio, you should feel comfortable they are fundamentally good businesses and will perform over the long run. So moving on to point number 3, and definitely the most exciting, prepare to pick up some bargains. With the potential second sell-off looming, now is a great time to go through your watch list and properly assess what stocks you want to add to your portfolio and at what prices. It's important here to note that you need to make sure you've got sufficient cash available so you can take advantage of these potential opportunities, whether that's by depositing more funds or by selling stocks you consider more risky or less core to your portfolio. So let's have a look at my watch list and see what stocks I would like to add to my portfolio and what existing stocks I would like to add more to should those prices fall in the next few weeks. So if I pull this out here just to make it a bit clearer and then change this into my current watch list, then you can see what I currently have in here. So I've got some spec stocks here, some growth stocks, a few which are recently IPO'd that I am watching closely. Those are Twilio, Trade Desk, Datadog and Fastly. I would like to add all of these, but to be honest, I think they're all a little bit expensive at the moment. Fastly in particular, I think has run up 300% in the last 3 months, so it's absolutely exploded. If that is to drop back down, then I will consider adding that. Splunk is another one I would like to add. Again, I think the price is a little bit expensive, so if that drops, that will probably be top of the list. We scroll down here. Nvidia again is another one I'm really keen to add. If I just click on here, and you can see the charts. So from its lows of about 190 in late March, it's exploded all the way up to above 360. So if it falls back probably to around where my marker is here, which is 300, I probably will look to add Nvidia, but at the moment it's just a bit too expensive for me. Next year in energy is also on there. I do like this for its sustainable energy sources, solar and wind primarily. It's an industry which is only going to continue to grow. The one thing which is putting me off a little bit is its growth over the last year or two hasn't been as high as I would like. I would be buying this as a growth stock, although I think it's seen as more of a utility, and for that reason the growth or the lack of growth is the reason I won't be adding this just quite yet. Some more on here. Shopify and Teladoc I'm watching closely again, too expensive at the moment. Persimmon, and I've got Taylor Wimpey down here as well. 2 UK house builders which I am keen to add at least one of. Pricing has dropped last week. If it continues to drop on Monday or Tuesday, I will be adding one or both of these to the portfolio. Housing in the UK is still in short supply. There is still a number of really generous government incentives, and although supply might dip a little in the short term, it's an industry which I could see doing well longer term. Moving down, another one, probably top 3 on the list, is PepsiCo. I do currently hold Coke. I would like PepsiCo just because I feel it's a little bit more diversified, given they own Lay's and Walkers in the UK. Price again is slightly too high. If that drops down into the teens, the 1-teens, then I'll probably be adding that, averaging in. If we then go into my existing portfolio here, the stocks I'm keen to add more to here are primarily these two, so Amazon and Tesla. I do hold decent positions in both already, but they are probably the 2 stocks I want to have my high I want to have my highest weightings and allocations too. So I'd like Tesla and Amazon to be roughly 8% each of my portfolio. At the moment they're both between 5 or 6, so if I can pick these up at decent prices, I will be adding more to these. Moving down, Johnson & Johnson and Unilever, two very defensive stocks, both of which didn't drop much at all during the crash given their defensive recession-proof nature. If they were to drop, I will be adding more to these two positions as well. So in summary, go through your portfolio, make sure you are comfortable with your current risk exposure, then prepare yourself mentally for a drop in the value of your stocks, and third, make sure you have your stock targets in mind and are ready to dive in and take advantage of any price drops in those stocks. Please also let me know your thoughts on my portfolio and let me know what you are looking at buying. To see more videos like this, please hit that subscribe button, and if you took some value from this video, please also give it a like. Your support will be very much appreciated. Otherwise, as always, I hope to see you in the next one.